Ever wondered how ExxonMobil and Chevron stack up against each other in financial performance? Well, you're not alone. These two titans of the oil and gas industry have been at the forefront of America's energy sector for decades, driving both our economy and our daily lives. As potential investors or simply curious minds, understanding the financial intricacies of these companies can provide valuable insights. That's where this video comes in. We're going to dissect the financial performance of ExxonMobil and Chevron, comparing their revenues, profits, assets, and more, all to help you get a clearer picture of these giants in the oil and gas sector. We'll look at everything from their total revenues and revenue structures to their operational efficiency and cash flow. And we'll do it all in a way that's easy to understand, no matter your background. So, let's dive into the numbers and see where these two oil giants stand. First, we look at the total revenues of both companies. As of the third quarter of 2023, ExxonMobil's total revenue stands at a whopping $253 billion, while Chevron trails behind at $148 billion. Now, if we take a step back to the same quarter 5 years ago, in 2018, we find that ExxonMobil had revenues of $211 billion, giving it a 5-year compound annual growth rate, or CAGR, of 3.7%. On the other hand, Chevron had revenues of $119 billion, with a slightly higher 5-year CAGR of 4.5%. Now, let's break down the revenue structure of both companies. ExxonMobil's revenue comes from several sources, with the dominant 80% stemming from energy products. This is followed by 8% from upstream operations, 7% from chemical products, and a remaining 6% from specialty products. This diverse revenue stream allows ExxonMobil to maintain stability in its financial performance. On the other hand, Chevron's revenue structure is a bit simpler. 23% comes from upstream activities, which involve exploration, drilling, and extraction of crude oil, natural gas, and secondary products. The lion's share, however, at a hefty 77%, comes from downstream activities. These involve the processing and refining of oil and gas resources into various chemical and energy products such as gasoline, diesel, mazout oil, plastics, polyethylene, and various chemical additives. As we compare these two giants, it's evident that ExxonMobil has a more diversified revenue structure compared to Chevron. This could potentially offer ExxonMobil a greater cushion against fluctuations in any one sector. However, Chevron's heavy reliance on downstream activities could be advantageous in periods of high demand for refined products. As we can see, ExxonMobil has a more diversified revenue structure compared to Chevron. Now let's examine the profits of these two companies. ExxonMobil and Chevron, two powerhouses in the oil and gas industry, have gross profit margins that are quite intriguing. ExxonMobil, with its diverse revenue structure, enjoys a gross profit margin of 31%. This means that for every dollar ExxonMobil earns in sales, 31 cents is gross profit. On the other hand, Chevron, with its more streamlined revenue structure, has a lower gross profit margin of 26%. Moving forward, let's delve into the net profits of these giants. ExxonMobil has a net profit of $28 billion. Over the past 5 years, it has grown at a compound annual growth rate, or CAGR, of 14%. This implies that ExxonMobil's profitability has been on a steady upward trajectory. Chevron, on the other hand, has a net profit of $19 billion, with a 5-year CAGR of 12%. Though Chevron's net profit is less than ExxonMobil's, its growth rate is only slightly lagging. But net profit alone doesn't tell the whole story. To get a clearer picture of profitability, we need to consider net profit margins. The net profit margin is a key profitability metric for a company. It represents how much of each dollar collected by a company as revenue translates into profit. ExxonMobil's net profit margin stands at 11%. This means out of every dollar of revenue, 11 cents is net profit. Contrastingly, Chevron's net profit margin is higher at 13%, indicating that 13 cents out of every dollar of revenue is net profit. This disparity between gross profit and net profit margins showcases how operational efficiency, cost control, and other factors can impact the bottom line differently. In conclusion, while ExxonMobil seems to have a higher gross profit margin, Chevron has a higher net profit margin. This highlights the importance of looking beyond just one financial metric when analyzing a company's profitability. understanding the nuances of profit margins can provide valuable insights into a company's operational efficiency and cost management strategies. Moving on, we look at the total assets, equity, and financial ratios of both companies. Let's start with total assets. ExxonMobil's total assets are a whopping $372 billion, a testament to their extensive operations. Chevron, on the other hand, has total assets amounting to $264 billion. While not as substantial as ExxonMobil's, it's still an impressive figure. Moving over to equity, ExxonMobil has an equity of $208 billion. Chevron, on the other hand, has an equity of $166 billion. Equity is crucial as it represents the residual interest in the assets of the entity after deducting liabilities. In simpler terms, it's what shareholders would receive if the company were to liquidate. Now, let's look at the equity to total assets ratio. This ratio gives us insight into the financial structure of a company and its financial health. ExxonMobil's equity to total assets ratio is 56%, which means that more than half of its total assets are financed by its shareholders. Chevron's ratio is even higher at 63%, indicating that its shareholders finance almost 2/3 of its total assets. Finally, let's dive into some key financial ratios, starting with the current ratio. This ratio measures a company's ability to pay short-term obligations. ExxonMobil's current ratio stands at 1.42, while Chevron's is slightly lower at 1.25. The quick ratio, which is a more stringent measure of a company's ability to cover short-term liabilities, is also higher for ExxonMobil at 1.08 compared to Chevron's 0.97. In summary, while Chevron seems to have a stronger equity to total assets ratio, indicating a greater proportion of assets financed by shareholders, ExxonMobil exhibits better liquidity, with higher current and quick ratios. This means that ExxonMobil has a better short-term financial strength to meet its obligations. Chevron seems to have a stronger equity to total assets ratio, while ExxonMobil exhibits better liquidity. Next, we analyze the operational efficiency and cash flow of these two companies. Let's start with operational efficiency, which is a measure of how well a company uses its resources to generate revenue. One way to gauge this is by looking at inventory days and accounts receivable days. ExxonMobil's inventory days are 38, meaning it takes them about 38 days to sell their inventory. Chevron, on the other hand, is a bit quicker, selling their inventory in 22 days. When it comes to accounts receivable days, ExxonMobil takes 45 days to collect payment from its customers, while Chevron takes 39 days. This means ExxonMobil is a bit slower in collecting its money, which can impact their cash flow. Now let's discuss total assets turnover, which indicates how effectively a company uses its assets to generate sales. ExxonMobil's total assets turnover is 0.91, while Chevron's is 0.76. This shows that ExxonMobil is more efficient in using its assets to generate sales. Moving on to cash flow. Let's start with operating cash flow, which is the cash generated from a company's regular operating activities. ExxonMobil's operating cash flow is $42 billion, while Chevron's is $23 billion. This means ExxonMobil generates nearly double the cash from its operations. Next is the free cash flow, which is the cash a company has left over after it pays for its operating expenses and capital expenditures. ExxonMobil's free cash flow is $26 billion, while Chevron's is $12 billion. Again, ExxonMobil comes out on top. Lastly, we have the operating cash flow to net income ratios. ExxonMobil's ratio is 1.5 and Chevron's is 1.2, which indicates that ExxonMobil has a higher proportion of cash flow to net income. To sum up, while both companies have their strengths and weaknesses, ExxonMobil has better operational efficiency, while Chevron has a stronger cash flow. Finally, we perform a DuPont analysis for ExxonMobil and Chevron. ExxonMobil's return on equity, or ROE, stands at 18% in the third quarter of 2023, driven by a net profit margin of 11%, an asset turnover ratio of 0.91, and an asset to equity ratio of 1.79. Chevron, on the other hand, has a return on equity of 15%, with a more impressive net profit margin of 13%. However, its asset turnover ratio is slightly lower at 0.76, and its asset to equity ratio is 1.59. Analyzing these constituent factors, ExxonMobil seems to have a higher ROE, indicating better efficiency and profitability. However, Chevron's higher net profit margin and stronger cash flow should not be overlooked. As always, investing decisions should be made based on thorough analysis and consideration. Thank you for watching. Please comment with the names of 2 companies you would like us to analyze next.